Hi, I'm Don Mecoy. I'm a business reporter with the Oklahoman. I'm joined today by Tim Courtney. Tim is the Chief Investment Officer at Burns Advisory Group. Thanks for joining us today, Tim.
Sure, my pleasure.
And we're here today to talk a little bit about the stock market.
Okay.
We lost about 300 points this afternoon, and everybody's wondering, how low can it go? You have any idea?
Well, it can always go lower. That's the first rule. But I have a sense that probably the next 20% move is going to be on the upside rather than on the downside. And the reason that I would guess that is because we are approaching the worst inflation-adjusted returns that we've ever seen going back to the 1920s. And so really there are only two other time periods that compares to what we're going through right now. One was from 1929 through 1932, and the other one was 1974, 1975. And both of those time periods, after you account for inflation, in fact, 1929 through 32, they experienced quite a bit of deflation. Right. We are approaching those two time periods where we're down about 50 to 60% from the peak of the market. So
we're looking at, this is as bad as it's ever been.
This is bad as it's ever been, taking into account kind of what people end up with purchasing power-wise after this market decline.
Well, that kind of leads to my next question. For people who have stayed in and stayed the course and they still have their money invested in stocks, or a portion of their money invested in stocks, should they just keep hanging in there?
I would, unless they need, the cash. And certainly there have been people and businesses that have had to raise cash to either pay back loans or to help their own financial situation, their own financial health. They've had to sell stocks. But if people are not in that situation, I would not sell stocks at this point. We use an analogy with a lot of our clients. If somebody were to walk up to your house and knock on your door and offer you 50 cents on the dollar for your home, would you sell it? I probably would not sell my home at that ridiculous price unless I absolutely had to have cash right then. So for most of these people who have cash in the market, they've ridden the market down, they've taken the risk. They need to see the reward of holding stocks. And so they definitely should stay in and get that reward that's coming.
Okay. Now, for people who jumped out, we've been falling now for quite some time. I know some people capitulated. They got out of the market, and they're sitting on the sidelines, hoarding their cash and getting very little return,
right?
And looking for an entry point. What should they be looking for? Is this it?
Yeah. This is definitely a good one. It may get better because, like I said before, the market can always drop, but people who are holding cash and cash equivalents right now, like bank CDs or money market accounts, coming out of these very poor market downturns like we experienced in the 30s and the 70s, people who held cash equivalents like bank CDs were hurt as the ensuing inflation took hold in the economy. And so people who were holding bank CDs or treasury bonds saw their purchasing power severely eroded. And that definitely happened in the late 30s, 40s, and 50s, and the 70s as inflation heated up. So cash equivalents is not a good place to be when we do recover. And I certainly probably what we're going to see coming out of this downturn is another recovery with inflation, with as much money as the government is looking at spending. They probably need to get into a position where they're buying some stocks, and they can have they can dollar cost average into the market. They can do several strategies to get in. But at this point right now, there is a lot of wealth being transferred from sellers of stocks to buyers of stocks. And during periods like this, wealth is going from one family who's selling it to another family who's acquiring it. And so I definitely recommend that if you have cash that you can afford to invest, this would be a good time to build wealth.
Well, and I've heard several people, and tell me if you agree with this, but I've heard several people say, I think the stock market will probably begin to recover before the economy does. Is that something you're anticipating as well?
Yeah. So, in every recession we've had going back to the late 20s, the market has hit bottom and rebounded before the recession has had an official end, before they've sounded the all-clear siren and said, okay, now we're out of recession, we're in growth again. The market on average recovers somewhere between 2 and 3 quarters before the recession end. And if you factor in the account that there's not that data is not released until months after So if the recession ends in December of 2009, we won't even be hearing about it until the first or second quarter of 2010.
Right.
So there's a huge lag time before we hear things are getting better and when the market hits bottom and recovers. So that's almost certainly to occur again.
So maybe the stock market can kind of be the canary in the coal mine for us.
Yeah, it is looking ahead about 2 to 6 quarters in advance.
Okay. Well, listen, that's a lot of good information and good advice, and we appreciate you coming and talking to us about it.
Sure.
We'll have a lot more coverage in the Oklahoman and on News OK, and look for it there. Thank you very much for joining us.